Hello and welcome. You're watching All About Your Company here on ET Now. I'm Harsh Saita. Today we're going to be talking about a transformers company and why is this one looking interesting? One is because it's in the power in the power supply chain. This is a critical element that it manufactures, which is transformers, a large part of what it does. And also in terms of the numbers, they are projecting a 40% growth for the next couple of years at the very least. We'll get a better outlook of it in terms of since the listing till now, it's not sitting on very significant gains either. This is a 2025 listing, and therefore, is this an opportunity or not is what we're trying to get to. In terms of, let's first dive in and understand what I want to know about this company in particular. It's done around 1100 crore of top line in this year, 9 months till date, but at a 40% growth versus last year, it will mean that they ideally do a top line of 1750 crore, which is a tall ask. Question is, will they do it or not? Q2 was a slightly softer quarter in relative terms, but Q3, you've seen a bit of acceleration. Q4, they will really have to drive top line, and we'll try and understand whether that's realistic or whether one should taper down with regard to expectations. Point number two, therefore, does a 40% kind of growth clip, is that something that is realistic for the next three to 4 years as the base goes up? The revenue base will go up, and therefore, what happens to top line and what happens to margins? We'll try and understand both of those aspects. The third piece is with regard to capacity. They're currently sitting at 63,000 MVA approximately. The immediate increase is going to be around 15,000 MVA, but there is significant room for expansion there as well. So capacity expansion from here, we'll try and understand and gauge as to how it plays out. The fourth piece is with regard to order book. The order book is around 1.4 times book to bill. Can it get better than this, and how quickly, or will they maintain it at this level? Also, how is competition shaping up with regard to order wins? Because the opportunity size seems to be large, but the order backlog within the industry is also very large, very unlike an Atlanta itself, which is not sitting on a very large backlog. And therefore, we'll try and understand those dynamics. The fifth piece is with regard to debt. Some bit of the debt repaid, but interest cost continues to be on the elevated side. We'll try and understand when does interest cost come off, whether there's any scope for further debt repayment, and if so, how quickly does that happen? The sixth piece is with regard to working capital and how does that get streamlined. In terms of the working capital requirements, it continues to inch upwards. The receivable days have also inched upwards, and the quantum of receivable consistently has gone up. Is that a concern? Is that normal course of business? How should one build in the numbers with regard to receivables, and how should one derive comfort with regard to cash flow? So we'll try and understand all of that. Now first, let's try and understand about the company and what the company essentially does. It's a leading manufacturer of transformers in India, one of the leading manufacturers. It has 30 plus years of experience within this space. The capacity across 5 facilities is on your screen. Now, in terms of exactly what it does, it's a manufacturer of transformers, it's a power-related equipment, right, which calibrates the flow of power from one place to the other when power is being transmitted through transmission lines. So there are various types of transformers, of course, and some of them will come up on your screen. One is power, which is used in utilities and renewables. The other one is auto transformers. It's largely for grid use, or for the purposes of the grid. Inverter duty transformers is for solar, wind, and the like. Furnace transformers are for industry, and generator transformers are for power plants, and then there are special duty transformers which are more custom made. As you go up the value chain, your margins get better. So as you're on the lower end of the value chain, the margins are lower, competition is elevated, but as you go up, the margins consistently start getting better, and that's exactly what Atlanta Electricals is targeting in terms of better margin product going forward. Let's talk about geography. It is currently present largely in India. They've won their first order from the Kuwait, Oman area, which is the Middle East area, is where they won their first export order. So that opportunity is also opening up for them. So that's something you want to look out for. The target is to get to 15% in terms of export versus 85% domestic, but currently pretty much everything, our understanding, is domestic. In terms of the business model, let's quickly try and understand that. It gets orders from the likes of a GEDC, which is Gujarat Energy Transmission Corporation, Tata Power, Adani Green, SMS India. So these, some of these entities place orders with Atlanta Electricals. Atlanta Electricals manufactures, supplies to them raw material, one of them being copper. The import reliance is low, but nonetheless there is some bit of import reliance. And then they rely on suppliers like an NKM Cables and a Vidya Wires to ensure that they deliver the product to their customers and clients. I also want to understand whether Chinese competition is hampering in any form or shape this particular space in India, and that will give us a color on industry-wide issues as well. So we'll get a sense of that. Now, let's talk about the key metrics that one needs to look for when one is looking at Atlanta Electricals. You look at the revenue and you look at the way in which revenue has moved. It's moved up to at a 28% CAGR. So we've seen very strong revenue growth. 1244 crore is what they've clocked in terms of their revenue in FY25. So very, very strong growth is what we've seen. In terms of EBITDA as well, we've seen a staggering 60% 3-year compounded growth in terms of EBITDA. So we've seen margins go up very, very sharply from 8% to around 16%. And that margin picture will come to you when we look at the operational metrics. But that is the reason why EBITDA has gone up, and profitability also has surged 91% CAGR over the last 3 years. So very impressive numbers, no concerns with regard to that. The concern is, of course, now on the higher base, can they sustain the kind of growth that they're clocking in? And we'll try and quiz management on that. You look at the margin trajectory, that will give you a sense. Okay, that's, of course, the numbers for 9 months FY26, cumulative numbers. Again, you'll see very, very sharp growth on that cumulative number. 33% top line, 57% EBITDA, and around 34% in terms of profitability. Interest costs inching up is one of the reasons why profitability hasn't gone up in correspondence to EBITDA. So that's something you want to look out for. When you're looking at margins, those are the margin numbers. For 9-month FY26, it's at around 18%, but for Q3 FY26, it's at nearly 20%. 19.5% is the margin that they've clocked for Q3. In terms of the other piece of the operational pie is, of course, the order book size. It's at around 2,500 crore versus the revenue of around 1,600 to 1,700 odd crore, and therefore a book-to-bill of around 1.5 times. And this is broad level, of course, when you're looking at the book-to-bill of around 1.4 times. FY25, the revenue was around 1,200 crore, so it's a book-to-bill of around 2 times is what it translates to. Around FY25 or midway or 1 year forward would be around 1,700 crore in terms of revenue. So something you want to look out for. Now, in terms of the balance sheet metrics, you look at the book value of the company. It's around 782 crore. It's a 6,300 to 6,400 crore market cap company. And the book value currently at the end of H1 is around 782 crore. This is, of course, FY25 pre-listing. Post-listing, it is at 782 crore. The borrowing number was at around 350 crore. From that 141 crore, there was a jump. There was plenty of capex which the company did. Thereafter, did a listing. And they're sitting on cash at the end of H1 FY25 of around 420 crore. So that's the other piece of the balance sheet that you need to keep your eye out on. 400 crore of cash at the end of H1. A lot of the IPO proceeds of around 400 crore, which was the IPO proceeds, entirely going to be used for the purpose of working capital, or rather to some extent to be used for the purpose of working capital, to some extent for the purpose of repayment of borrowing, and therefore borrowing cost ought to come down. We'll try and understand how that plays out on the P&L number, because of course we don't get the balance sheet at the end of Q3, but that's broadly the way in which one would expect it to play out if the borrowing number were to come down. Now let's talk about the cash flow number. Now this is where some concern starts to creep in. You look at the cash flow to EBITDA conversion, it's clearly not happening. It's happened in FY24 to some extent. FY25, it's not happening. And FY26, the sense is that your receivables number will continue to remain elevated. So we'll try and understand whether there is any unwind of the receivable number which is expected, or whether receivable days continue to inch upwards or remain stable at around 100 days, which is what they were at. When you're looking at the net cash flow, less relevant, but nonetheless that capex number will keep the net cash flow number slightly deflated. Also, working capital requirements is what they're planning to use 200 to 300 crore of the IPO proceeds for. So we'll also get a sense as to whether that goes into repayment of borrowings or fresh working capital requirements that are going to be coming on stream. So cash flow again is something we'll try and judge better. Return ratios. Now this is where the company really stands out. They've done fabulous return ratios. This is very, very strong return ratios for an Indian company. Whether they can sustain this or not is really the question. It's come off, sure, but a 39% ROCE ratio is clearly very, very strong. So that's credit to the management and the kind of business that they do. Let's talk about shareholding now. In terms of the pre-IPO shareholding, promoters owned around 94%. They diluted around 7% as part of the IPO. And what you see otherwise is the FIDI and public holding as well. So plenty of skin in the game. The only reason we've given this cautious neutral rating is because of the fact that there's still some promoter dilution which is yet to come. So maybe some overhang could continue on this counter as a result of that, because minimum public shareholding norms will need to be met. Now either they do it through an equity dilution, a further equity dilution, or they sell stakes. So one of the two likely to happen, of course, as they bring that down. Now let's talk about valuations and guidance. And here's where it starts to get very interesting. 40% revenue growth is what they are pushing for. Margins likely to continue to improve. They're going into higher voltage products where there's lesser competition, and therefore margins should go up. We spoke about this. The goal is to reduce debt post the IPO. We'll ask how much is that so, and finance cost as well is likely to come down, is what they've guided for. It currently trades at around 45 times when I'm looking at the trailing 12 months price to earnings. But if I were to just push the earnings to FY27 and give it a growth of around 30% on the top line and 17% on the margin count, you arrive at around a 25 times price to earnings for FY27. We'll try and understand that better. In fact, let's bring on board the management of the company, Niral Rupesh Bhai Patel. But what we'll do is we'll slip into a very short break before we speak to you, sir. He's the chairman and managing director of Atlanta Electricals. Going to talk to us in just a couple of minutes, viewers. Thank you. Stay with us. Just on the other side of the break, that conversation with Mr. Patel. Welcome back, and we're assessing Atlanta Electricals today on All About Your Company. And if you could quickly bring out the snapshot of everything we've just gone through and discussed about with regard to Atlanta Electricals. Let's also bring on board Mr. Patel, who's the chairman and managing director, Niral Patel, who is going to be speaking to us about the company and what to expect going forward. Great having you, Mr. Patel. First time I'm interacting with you, so great chatting. Let me first start off by getting a sense from you. This 40% growth guidance you've given, FY26, is it doable, or is this FY27 and beyond?
Thank you, Harsh. Thank you, Harsh, for having me here today. Good afternoon.
Great having you.
The 40% guidance that we've been giving is absolutely doable, and the guidance is based out of facts and numbers. We did an expansion which quadrupled our capacity by start of this year, and this capacity came into production in this particular quarter itself and delivering results. And that is the reason we're seeing about 80% growth in the revenue and a significant jump in the EBITDA levels also. So 40% year on year is clearly doable, and the company has planned for such kind of growth.
Okay, and therefore, for how long can this 40% growth sustain? I'm trying to understand whether this is a 2-year story, 3 years, because the base will catch up with you at some point.
So transformer market is at its inflection point as we speak. India has a lot of requirements for transformers. There's a huge demand that we are catering to. There's a renewable sector. There's EV. There is BESS coming in now. There's green hydrogen eventually. There's going to come in on the consumption side. We have railways. We have data centers. So a huge requirement of transformers is there. However, to ensure the 40% growth year-on-year basis, Atlanta, the way we have planned is increase the market share and also expand on the technology front. So more and more you go up the KV class ladder, the margins tend to improve, the order books tend to grow bigger and bigger, and the volumes are achievable.
And how's the order flow coming in, Mr. Patel, for you? Will the higher KV be more private participation? Is that how it works? Talk to us about how it works and what's the order traction looking like.
The order traction is good. The company has taken a strategic call not to take further orders in 400 kV class. We've already received a lot of orders in 400 kV class. That will be the first prototype the company would be developing. As soon as the company is able to develop this first prototype, we would be opening our gates for 400 kV class. The 400 kV class order book the order pipeline is quite huge. It is almost equal from the government and the private sector. Private sector markets have been growing because the government is now focusing more on the TPCB model, wherein the private partner, it's a public-private partnership where a private entity would be investing into the substations and creating this infrastructure for the government. So we've seen a lot of orders coming in from the private sector as well. The orders that we have received are from the private sector. The facilities are up and running for 400 kV class, and we intend to get these facilities approved through the government contracts for getting 400 kV class orders from the government.
Okay, you're suggesting that competition here is lower and hence margins are better. How about China? How are they placed in terms of competing for the same orders or the same pie of opportunity that you have?
Margins. So as we go up the KV class ladder, the margins and the volumes are much, much better. And that's the reason Atlanta was the first the first company to do such kind of capex and acquisition for the higher KV class in the industry. And that's the position that we enjoy. When we compare India versus China, the Chinese competition is more or less, the prices are more or less same. So it's not that the Chinese are more competitive. However, the Chinese markets are completely flooded with their export orders from Australia, Middle East, and African countries, where all the Chinese manufacturers are catering to them. So we don't anticipate much competition coming in from the Chinese markets in the Indian market as we speak, because our Indian government also has a restriction where we need to set up the facility here and start supplying from the Indian facility. Can you understand? These are large capex items, so a lot of maintenance also is required. Service support is also required, and that's where Indian OEM manufacturers are preferred.
Oh, is it? Okay, so this is an interesting piece. If I can ask you a follow-up on that, how much of your revenue comes from service and how much of your revenue comes from product?
So we are mainly an OEM manufacturing company. We don't enter into service requirements unless the customer himself wants a service from the OEM manufacturer. There are separate companies, separate bodies who look at AMCs of these transformers, and then they eventually end up taking indirect support from us as and when required. When I say service support, these are for large transformers, the higher kV class that we're talking about. And based on those reasons, two Chinese companies had already invested in India. One of them is currently functioning, and one of them is what we had acquired.
Okay, you'll likely get to 2,500 crore in terms of top line as early as FY27 if you do a 40% growth. And from there, you will get to 3,500 in FY28. You believe that order wins will continue to to be quite robust for you to get there? Because you're currently at 2,500 crore in terms of order book. So what's the order book visibility like? Is this a conscious calibration of the order book, keeping it at 1.4, 1.5 times? Or how does one look at the order book evolve as you continue to grow?
So, the order books are considered at a fairly healthy level if we are talking about 220 kV and below, and that's exactly where Atlanta is focusing right now. So, a 700 crore quarterly order intake is considered fairly healthy for 220 kV class transformer and below transformer manufacturing. Like I said, as in when we open our gates for 400 kV class, where the lead times are more, the order pipelines are even bigger. When we say lead times in the 400 kV class is close to about 18 months. So that's where the order book starts building up substantially on the 400 kV class and 765 kV class segments. We anticipate the first prototype to be done by, say, Q1 of next financial year. And that's when, it would give us confidence to open up into 400 kV class segments.
How quickly do you scale capacity? You're currently sub 80,000 MVA, if I'm not wrong. Correct me if I am. And how quickly do you scale from there and to what level? And could you give us timelines?
It's a sizable capacity already built up as we speak. We were at 16,000 in FY25. We are now at 63,000. So that's a quadruple capacity increase in terms of greenfield capexes and acquisition. Our intention would be to at least utilize the facility to its 80%, and that's when we would be scaling up. The facility that we've acquired and the facility that we've built greenfield both has expansion plans. However, as we speak, there are no current large expansion plans. A small expansion plan is already in the pipeline where it's a 65 crore capex where we would be manufacturing inverter duty transformers mainly for solar in mass production. And that's coming in. That's close to about 5,000 MVA. So that will be coming in Q3 of next financial year.
Okay. And as you scale towards 2,500 crore. Let's talk 2,500 crore FY27. How do your margins evolve? Can you build on and probably even breach 20% margin, or that's too ambitious?
So margins, like I said, the current margin profile of this quarter itself mainly comprises of orders below 220 and 220 kV and below. And largely the increase is because of high production of 220 kV class in our Vadod unit. The margins of 400 kV class are better, and they are naturally better than 220 kV. However, when the company shifts its gears from 220 to 400 kV class, there's a lot of technology development cost that comes in. So we anticipate margins to be really going better by FY28, where these technologies have been developed and they have been acceptable. The prototypes are acceptable to the Indian markets, government and private both.
Mr. Patel, I have only 30 seconds left. If you can tell us quickly with regard to cash flow and cash flow conversion, which is EBITDA to cash flow, and with regard to working capital, what's playing out?
We had close to about 350 crores of debt. From the internal accruals, we were able to repay majority of it. There's about 65 crores long-term debt pending. We've predominantly utilized our IPO proceeds for working capital. So the cash flow is good. We are able to repay majority of our long-term debt, approximately to the end of 300 crores. The cash flow cycles of last year, the numbers that we are projecting, that is because Q4 in our industry is significantly heavy. A lot of sale happens, a lot of projects get finalized, capitalized in the Q4, and which we anticipate in this coming Q4 as well. And that's the reason the cash flows look a little skewed, but on quarter-on-quarter basis, the cash flows look significantly good. The liquidity position of the company is pretty healthy. We don't face any liquidity concerns. Even after all the manufacturing facilities are significantly loaded in terms of working capital.
Okay, Mr. Patel, this has been a pleasure. We've understood this far better. Thank you so much for coming in and speaking with us.
Thank you. Thank you. Thank you for having me.
And viewers, that's all the time we have on AYC today. Thanks for tuning in.